Welcome back, everyone, to CMCAP-U Schools in Session. Professor E in the house. Hope everyone's having an amazing summer. So for today's class, I'd like to introduce the concept of beta and how it ties into diversification. Beta, B-E-T-A. I'm sure we've all heard the expression, don't put all your eggs into one basket. Seems logical, pretty simple. In short, it's important to diversify. However, for today's class, I wanted to explain how to diversify and more importantly, how not to diversify. Let's start with stocks. You ever notice that when the stock market is hot, almost all the stocks go up? And when the stock market is bad, almost all the stocks go down? That's because the bulk of the risk when you buy a stock is attributed to the overall market. So in short, you're often not so smart when the stock goes up, and you're often not so stupid when the stock goes down. Proper diversification is not buying a whole lot of different stocks. It's buying a whole lot of different asset classes. To that point, I wanted to introduce the concept of beta. Beta is a measure of systemic market risk. What does that mean? Meaning, as just mentioned, most stocks tend to do well when the market does well, and most stocks tend not to do well when the market doesn't do well. How well or how not well depends on the beta. So a beta of 1 suggests even correlation to the market, meaning if the market goes up 10%, our stock should be up 10%. And if the market goes down 10%, our stock should be down 10%. A beta of 2 suggests double correlated, meaning if the market is up 10%, our stock is up 20%. If the stock market's down 10%, our stock is down 20%. From my standpoint, that's a horrible way to invest your money because we have zero control over the market. So we're essentially putting our money at risk based on something we have no control over. That being said, a prudent investor will look to properly diversify, and a properly diversified portfolio will look to have a beta of 0. No market correlation. Market goes up, market goes down, it doesn't impact our portfolio. Our investments will either succeed or not succeed based on the merits of the investment, not the market. How do we do this? Different asset classes. We buy stocks, we buy bonds, we buy commodities, we buy real estate. We buy stocks, bonds, commodities, and real estates in different markets, overseas markets. That's how we get a properly diversified portfolio. At our next class, we're going to introduce some of our alternative investment ideas and explain how we feel they're great complements to conventional brokerage assets and how they help us better diversify. And now we'd like to thank you for your time this evening. And we'd give you our typical PSA that you should consult your investment advisor or your professional and your accountant before you conduct any investment. Have a great night.